Hey, best ever listeners, welcome to the best ever CRE show. This is Beyond Multifamily. I'm Amanda Cruz, joined with Ash Patel. Hey, Ash.
Hey, Amanda, and hello, best ever listeners.
Ash and I are with today's guest, Matt Drouin. Matt is joining us from Rochester, New York. He's the managing partner of Oak Grove Development. They are value add commercial real estate investors. His portfolio consists of 25 properties across a variety of asset classes with a combined value of 18 million. Matt, thanks for joining us today. How are you doing?
I'm great. I'm glad to be back. And I've been so fortunate to have you guys as this incredible asset to the real estate community. And I appreciate everything you do.
What
Awesome.
an
Well, we're
opening.
really looking forward to chatting with you today.
Matt,
Update the best ever listeners, if you will. Yeah, you've been here before. What are you working on now?
Yeah. So my background started in small multifamily, then went into sort of mid-sized multifamily. And over the past 6 or 7 years, we've actually explored different asset classes. We are, I guess I'd call asset agnostic, opportunistic investors. And we found a great niche in acquiring actually office properties, if you'd believe it, at really steep discounts to replacement costs. And that's what we've been focused on over the past several years since the last time we've been on the show.
let's dive into that. We love office. I'm assuming you're buying post-COVID.
Yes, absolutely.
All right, and you're buying it at pennies on the dollar.
Yeah, that's the idea. I mean, the strategy is essentially is that we buy stabilized office deals that we can get financing on from day one, that cash flow from day one, and exit, our exit strategy is to add value through lease up. We're able to buy and acquire assets at a discount to replacement costs. So we're able to cut really aggressive lease deals with new tenants coming in. And then if the market doesn't take to absorbing the product that we do have, then we have essentially a cost basis play that we can turn into a residential conversion, which I'm actually sitting in a building we're going to be converting into residential in the next 18 months.
What's the average occupancy of these offices that you're buying?
They range from, let's say, the building we own down the street is now 100% occupied. And the building that I'm sitting in right now, I think is probably like 40% occupied. There's definitely a wide range. And it also depends upon the asset class of office. We're finding that C-class office is the one that's actually struggling the most, but highly amenitized buildings that are in good locations with good parking, we're having no problems leasing up and also renewing leases with current tenants.
All right, so sorry, Amanda, I know you're trying to get in. I want this to be a lesson. Take note to all the multifamily investors. You can literally buy an asset with 40% occupancy that cash flows.
So let's turn some of the haters that I know we're going to have on office into believers. Matt, let's talk about the numbers here. You're sitting in an office building that's 40% occupied. How did you find it?
It was a deal that I kind of manifested into being. We own assets in downtown Rochester, adjacent to this building, and it was one that I had walked by like every day. And it's an incredibly pretty brick Romanesque building. It's one of the first skyscrapers that was built in the country. It's called the Wilder Building. And I was like, one day I'm going to own this property. So I started by contacting the leasing broker that was had a sign in the window and expressed my interest in potentially acquiring the deal. And I built that relationship over time. Their initial pricing guidance of $1.8 million, this was back several years ago, just was too high for the deal. And we ended up finally settling on 1.5 million for an acquisition price. And that's when we pulled the trigger and ended up buying the deal.
How many square feet is it?
It's about 55,000 square feet.
So you're getting a property at $30 a foot, but it's only 40% occupied. Okay. What were the lease rates at the time for the 40% that were occupied?
Oh, the lease rates right now are absolutely abysmal on C-class office. I mean, we have tenants in this building that are anywhere between like paying $5 a foot to $14 a foot for very, very small, like singular office, like executive office spaces. So the range is definitely not great for C-class office. It definitely is struggling, at least in Rochester, New York. But this is one of those plays where we're able to get acquisition financing in the property based upon buying it right. And we found that after operating the property, that we're able to increase the occupancy from, let's say, 50% when we originally bought the property up to 80%. And then at the lease rates we were releasing it up at, we were finding that we weren't having enough cash flow to actually pay for long-term major maintenance capex for the property. Amidst this discovery, we had both passenger elevators on an 11-story building go down. So if you can imagine this, the tenants that were on the 11th floor of the building were not very happy of having their clients and customers having to hoof it up 11 stories of stairs. So we actually the occupancy of the building plummeted over 12 to 16 month period, and then we're just like, you know what, we got to make a decision on redeveloping this building. Our original thesis of acquiring it and repositioning it as like affordable, cheap office. It's in a really great location. Just wasn't going to pan out for a long term sustainability for the asset.
How long were the elevators down for?
They were down for 3 months. And that was long enough.
What did it cost?
How much was that going to cost?
Yeah.
So an elevator modernization project, which is what essentially is needed on these buildings, is about $270,000 a pop. So we're talking over $500,000 to modernize both passenger elevators. On a total, let's say capital stack of a deal of, let's say, when we're adding in the total value of the property of let's say $3 million, $500,000 is a lot of money. But when we're talking about turning it into a $20 million redevelopment project, $500,000 is kind of like a line item as a capex when you're talking about a residential conversion. So elevators are not, if you talk to anybody who owns buildings with elevators, they're usually not happy about having elevators, but it is what it is when you're talking about high rises.
What makes this building ideal for a residential conversion?
It has a proof of concept. We have a few buildings that are right adjacent to it. There's 30 West Broad, which is the old Rochester Historic City Hall. There's the L. Wenger Berry building. There's the Gannett building that are all close to this property that have just recently been redeveloped. And we've been watching the lease ups very, very closely. And they've been leasing up in 6 months or less and at above pro forma rents from those neighboring developers that we've become friends with. So, the trend is our friend within residential conversions in downtown Rochester. And the other thing that makes this project attractive to de-risk it is that since it is a historic building, it qualifies for historic tax credits as well, which can greatly subsidize the capital stack in a redevelopment effort.
Matt, did you go into this purchase assuming you were going to keep it as office and just sort of wait it out, or did you always anticipate a conversion?
No, I mean, the original thesis was, plan A, we're getting it at a good basis. We're just turning into a lease up play, cut aggressive deals on lease ups. We've done this in the past with other deals that we've acquired. And, that thesis didn't pan out. And that's the important thing about having optionality with your business plans, especially on, heavy repositioning efforts like this one or redevelopment efforts. Is having that optionality, and the way you have the optionality is by having a good basis on your actual acquisition, so that you have enough equity spread on the back end to have multiple options with way you want to reposition or redevelop a property.
There's a lot of office buildings that are not well suited because of their floor plan, because of where the plumbing is. Are these buildings unique because they're older? They're better suited towards residential. Are you going to have wasted space when you do these conversions?
That's a great question, Ash. And thank goodness, no. I mean, this building was built in 1888. And during then we didn't have,
cubicle farms. You didn't have cube farms.
Yeah. We didn't have two by 2x4, like UV lighting and that sort of thing. So this building has a ton of windows. It's actually in a U shape. So it is really, really ideal for a residential conversion. We have a very, very minimal amount of common area loss factor with the conversion on this. So we're not going to have like long, creepy hallways and a ton of wasted space in the middle of the building. The buildings you see there are office buildings that were built, like let's say during urban renewal, during like the 1960s, 1970s, have massive floor plates, and they're very, very difficult to convert to residential without losing, like let's say, 40% to 50% of the building.
Is your plumbing consolidated to one part of the building?
Yeah, the floor plates aren't really that big. I mean, they're about 5,000 square feet a piece, and we already have a couple of chaseways already built into the building through old mechanicals that we can use for the plumbing stacks and also running the other MEP into the building.
Perfect.
Are you planning on executing on this conversion, or are you going to sell it to another investor?
No, this may be irrational, and this is a good thing about having doing joint ventures versus syndications and keeping your ownership group small. Is that I've always had the dream of converting one of these old pretty buildings and breathing new life into it by converting it to residential. So I think that this is something that we're going to look forward to. I want to see it to completion and stabilization. Because of the actual subsidy programs in New York State, we're going to be able to convert this into apartments that are at 80% AMI, area median income for workforce housing, and this is not going to be a low-income housing tax credit project, and is going to be a good cash flow play that we can hold for the next 20, 30 years.
I love these emotional decisions.
Yeah, they make
I've
no
done
sense.
a lot of those. No, that's okay. You fall in love with the building. There's nothing wrong with that.
Mm-hmm.
It's really cool that you're buying different types of assets too. Like, that's scary to me. I think to a lot of investors, you kind of find a few things maybe, or even one for some people that they really like, and they just kind of go down that path and learn everything about it. And you said you're asset class agnostic. Can that also go wrong? Like with these elevators, for instance, that just failed? What's a horror story from just buying an asset class that maybe you didn't know as much about?
Well, the good thing was that for about 6 years, I was director of operations for a national real estate development company. And this company that I worked for, we had assets across the entire real estate spectrum. And my job as the director of operations was essentially turn around management, to turn around troubled assets, get them bankable so that the principals of the company could refinance them and take out their bridge debt on them. So I've been exposed to multiple different types of business plans, from hotel conversions to student housing to regular multifamily, mixed use buildings, retail strip plazas, self storage deals, mobile home parks. So I've been able to built out a lot of experience infrastructure, and knowing and having a lot of experience with heavy quick turnarounds on properties. So I think that our one area where we're not agnostic is location. All of our assets we own in the city of Rochester, not even in the suburbs, in the city of Rochester. So we know all of the players, we know all of the street by street, block by block throughout the entire city. We know all of the lenders that are in the market, what types of asset appetites they have for different types of collateral. And we know all the decision makers from a policy perspective as well, that we all have relationships with those, from members in the city council to all of the people that work in city hall. So that is a tremendous asset that allows us to be flexible when it comes to asset class. But it's been a really powerful asset for us as we grow in the Rochester area.
Matt, with all that experience, how did you miss 2 elevators?
It was always something that you got to be careful of elevators that not super old elevators, but elevators that were let's say installed in the 1970s and 1980s that were using analog type of equipment. There's nobody that works on these things anymore, and we were able to bring both the elevators back into operation, but we had to call in a lot of markers from elevator companies we had relationships with. And so we actually had to get several control boards pulled out of, and these control boards, you look at them, they're you're looking at an Atari, right? These are not digital types of things. And so our elevator contractor had a relationship with some company that was in the foothills of Virginia that, this is the only thing they work on. And they shipped these things out, they rebuilt them, they sent them back in, and we were able to get them back in operation. But that was a Band-Aid. And God willing, this we're going to be able to get to carried through construction, for instance. But we know the writing is on the wall with these older elevators. So it was something that was in the back of our mind that could happen, but we were kind of thinking, okay, we have two passenger elevators, so if one goes down, we're going to be able to work with our elevator contractor to get it back up. But we had no idea that, okay, worst case scenario, two are going to go down at the same time with the same time period. Absolutely not.
Fair enough. Yeah. Lightning doesn't strike twice.
Yeah, sometimes it does.
Matt, you started out in multifamily. What was your first non-residential investment?
First non-residential investment was it was a smaller deal. It was a 6-unit deal. It was 4 apartments, 2 commercial storefronts. That was my first foray into non-multifamily assets. And it was by accident. I was a direct mail junkie. I sent out, postcards and direct mail. I used to send out these little, little love notes in a greeting card size, sort of envelope. And one seller or one owner responded to me. They're like, "Hey, I know you mailed me on a 6-family property owned in a neighborhood where you own other properties. I'm not really looking to sell that right now, but I do have a mixed use deal in another neighborhood that I might be willing to hold some paper on." So I walked that deal. I was really scared. I was like, there's 2 commercial storefronts here. Yes, they're occupied right now, but everybody's driven through a neighborhood and seeing the for lease sign on a vacant storefront for years at a time. But I was getting it at a good basis so that, if I had those apartments that were leased, at least I'd be at a break even point. And I could take my time in curating the best tenants for that mixed use building. And so that was my first foray into myself, me as a principal doing a non-residential deal to kind of let me dip my toes in the water.
For the best ever listeners, that is a great way to get into retail or other asset classes because, correct me if I'm wrong, Matt, but most of the time, the apartments should pay for all of your expenses. The commercial spot is just pure profit. Is that right?
Yeah, that's the way. I mean, I didn't have it like a scientific way of looking at it, but I was just I ran the numbers. I underwrote the deal conservatively. I was like, okay, if these 2 storefronts go vacant for the rest of my life, I'll at least be able to, I may be, in a little bit of hot water with my bank by not maintaining the DSCR, debt service coverage ratio on it. But at the very least, I could at least pay my bills. And we've never had a vacancy for more than 3 months in this building. We've been able to push the rents every single year on it. So it's kind of that proof of concept and confidence builder that I needed to at least explore other asset classes. And, I started buying, office buildings after that point in time and industrial and purely retail assets as well. And kind of utilizing that as a first experience of that.
My opinion is there's still so much stupid money chasing apartments. Do you find that as well? Or are you still actively looking for apartment deals?
We're not really actively looking for apartment deals. I mean, opportunistic, right? So if there was a deal that came across with a super motivated seller, which has been, difficult to find in this market, then that might be a deal we would consider. From a emotional standpoint, let's say, because let's talk in irrational terms, I've really enjoyed the relationships I've had with our business tenants. It feels like a partnership. It feels like there's a mutual alignment of interests, and they're only successful. They're only successful. We're only successful if they're successful. And so I really liked that aspect of it. Of walking a prospective tenant that's moving out of their garage, for instance, or their home office, and opening up their own whatever, a therapy office or whatever it might be, and they're scared as heck. And I'm able to say, hey, listen, you're going to do just fine. And being able to lease this space to them, and then 6 months later, they're calling me for more space. I just think that's amazing because we're actually able to add economic capacity to our community, and I get a lot of enjoyment out of that.
It's a lot of fun. And back to the apartment investors, would you ever just go visit your tenants and hang out with them? Never. But commercial tenants, look, I bring my kids to the restaurants that we own, the toy stores, all the salons, the barbershops. It's so good to see thriving businesses and knowing that you had a hand in that, right? Yeah.
Yeah, just playing that small chapter, I think. And I do the same thing with my kids. I bring them to our tenants. We have one tenant that's a crumpet shop. For those of you who don't know, a crumpet is like I don't know if it's a pastry or a very glutinous type of product that comes from the UK. And my daughter absolutely loves it there. The owners know her. She's able to meet my tenants who are successful small business owners. So she's able to be exposed to, other people that are exploring their own entrepreneurial path. So yeah, like I said, that's the other reason why I've like never done a syndication, for instance, is because there's a lot of things that I do that don't have a lot of like, spreadsheet friendly type of math. A lot of it I, do based upon instinct and the way I feel. And after being 19 years in the business, I think that you can start to go based upon how you feel at that point in time. That's why I love the other asset classes.
That's really interesting that you said you don't like syndications because you want to go based on and gut feel, and it's worked out. So what are you looking for with a potential acquisition? Like you said, 1.8 didn't work for this office, but 1.5 did. Was that just your gut telling you, or is there a certain metric you're looking at?
Yeah. So on these deals, I underwrite based upon worst case scenario. And so, 1.8 certainly wasn't a bad price, but it was just too tight. The way that we underwrote it was like based upon in-place occupancy. So we looked at the rent roll, and we looked at, okay, what would be a discount to current market cap rate for this area and the asset class, and that's how I came to the number of 1.5. Like, yeah, we wanted to pay less for it, but 1.5 was a great number for us to have enough equity spread built into it to have optionality to go in several different directions if we needed to pivot.
How are you finding deals, Matt? You said you got direct mail was your first commercial deal. Does that work now?
No, for commercial, yeah, I burned $25,000 in direct mail campaigns trying to acquire commercial deals. It's a different business. It's a much longer life cycle. You're dealing with the quintessential unmotivated seller most of the time. When you're looking at commercial deals, they're more sophisticated. You're not buying like a house from a little old lady that can't keep up with it anymore. I find that the best way to actually do it is through one, keeping top of mind with other investors in your community that, you're the investor that buys pretty brick buildings, which is pretty much everything that we own are like pretty old historic brick buildings, and also the brokers in the area as well. I've always been a member of our local trade association, which is the New York State Commercial Association of Realtors. I'm a former formerly on the board of directors. So just staying tight in with the community and building those relationships and keeping top of mind with brokers and other investors on specifically what types of assets you do buy and desire.
Matt, over the years, a lot of people have said, stick to one asset class, be hyper focused, stick to what you know. And that's great when the arrow is going up and to the right, but now it's not. What are your thoughts, or what would you say to somebody that says just hyper focus on one niche?
I think that if you, now one thing is like, if your whole experience has been in multifamily and you're looking at, well, multifamily is like, cap rates are too low. I can't make the numbers work. The interest rates are too high. So why don't I explore a different asset class that I know nothing about? There's a certain learning curve associated with that. So you do have to invest a lot of time into really understanding the ins and outs of that type of asset class, because they're all different, from industrial to retail to office. So I think that starting there first, from educating yourself, going out there, meeting with people that are active and successful in that asset class, if you're going to consider making that pivot to a different asset class. But I think that once you acquire the experience and build out the infrastructure, I think that you can afford at some point in time to be opportunistic and asset class agnostic. But that takes time, and that's the benefit that I've had from all of the mistakes and experience that I've had along the way.
Matt, do you prefer to bring in partners? You said JV partners mostly. Do you bring them in for equity or as debt?
Both. So we've brought in private money lenders that have just been complete, just debt partners, and then we've brought in equity partners as well. We don't put together ownership groups where we have like 20 different people that are equity partners. Generally, we don't want to deal with more than 2 to 3 people on a particular deal. So last acquisition, which was about a year and a half ago, which is the Court Exchange building in downtown Rochester. It was myself, my partner David with Oak Grove, and another developer around town. We got the deal under contract, and then we contacted people we had relationships with that we knew, like, and trusted, that we believed could bring value to the table, and we brought him in, and that's what helped us get that deal done. But I had that deal with private money lenders lined up to take that down, and Dave and I would have been able to keep 100% of the equity in the property. The reason why we ended up taking the worst deal and giving equity up was because this particular developer had a ton of development experience, not only from ground up, but from a historic adaptive reuse experience. And we saw kind of like the whole is greater than the sum of the parts, that there could be synergies within which to build upon in the future, to have this person as an ally by doing this deal. So it's kind of like, I think if you're doing larger deals, then equity makes sense. But I mean, if you're acquiring, like, let's say $1 million deal to $5 million deal, I think keeping it simple from just using private money lenders is really the ideal way to go. Because if you're dealing with an asset that, let's say, cash flows $30,000 to $40,000 a year, and you're going to have a partnership return that's required on that. And we pay our CPA anywhere between $2,500 to $3,000 a year for that partnership return. So, and that's like, that's a decent chunk of the actual cash flow itself. So I think that the deal needs to be big enough to bring on equity partners to make sense for us, because I think that at the end of the day, we want everybody to be interested that's in it. And I think you'd be surprised too at how many people, they just want a guaranteed fixed rate of return. And that's it. I mean, especially we're seeing that in this market, especially when you look at equities.
What is that current rate that people are seeking?
The raises we've been doing has been around 10%.
Yeah.
Rewind about 3-4 years ago. I mean, we were offering out 7% fixed rate of return, personally guaranteed by us, guaranteed by our entire company. It's like essentially like, if we fail and we can't pay you back, you take our house kind of guarantee. And we were oversubscribed in those, but it's a different environment because the cost of capital is so much more than it was. The risk-free rate of return back, rewind back then was like, less than 1%. And now, we have a significant amount of our cash in, an FDIC insured money market account that's paying us 4.75%. So you have to be, look at what fixed income is paying out there. You got to be, you're not providing something that has liquidity like other fixed income instruments. And you have to offer a certain amount of risk premium above that. And we're finding that around like 9-10% is where we're getting deals done that makes our investors happy.
Matt, I love that your company is known as the developers, the guys that save historic buildings in Rochester. I'm sure the city relationships, tax abatements, all that stuff plays in your favor. But at the same time, why not expand? Why not go outside of downtown Rochester?
Because Joe Fairless told me not to. I was actually on a call with him, I think it was like 7 or 8 years ago. I don't remember when, but I was exploring going outside of Rochester and into other markets that I had experience with when I was the director of operations for that development company. And he was like, "Why don't you just dominate your backyard?" And I was like, "Well, there's this one guy that buys all the properties in Rochester." And he was like, "Matt, I hate to break it to you, but that guy exists all across the country. And you have an incredible, competitive advantage in your own market with the relationships you can build over time and that infrastructure. So if you want to invest in another market, find another operator that's doing exactly what you're doing and partner with them. Because I think that's a, much less risk than trying to go ascend the learning curve, doing it the other way."
All right, let's pick on Joe. I've said the same thing to him. Why not invest in office, retail? His answer is it's not scalable. Mm-hmm. I get that, right? I mean, he's built a giant company, $3 billion assets under management, vertically integrated, but he's looking all over the country, or well, all over the Southeast, let's say.
Yeah.
I still don't buy that for you. You've dominated a fair amount of Rochester. Why not make larger concentric circles and go outside little by little?
I mean, I think that in the greater Rochester area, we would certainly do that. All right. So if we're talking about the suburbs, for instance, yes, that would be an easy move. But going outside, even in like, let's say outside of the Western New York area, maybe we'd go into Syracuse or Buffalo. If there was an asset that we could acquire, that would give us economies of scale to really establish that footprint, is something we would consider, because I know both of those markets, not as well as Rochester, but I know them well enough. So concentric circle wise, yes, but also at the same time, opportunistic investors, it requires patience. And the other reason why we don't do syndications is that we don't want to be feeding the beast. We can afford to go for the rest of our life without ever having to acquire another asset. So I think that if we can focus in Rochester and maybe the greater Rochester area in terms of the suburbs, like that, we'd be happy with that. I mean, we have enough as it is already, and we really don't need to at this point in time, the 10x rule used to be something that I was focused on, but not this point in time in life. I'm 41 years old. I have 2 kids, and I do value freedom, but more important than freedom, I value peace as well. And that's what I've learned over the past few years.
Let me ask you this. In 10 years, do you think maybe 15 years, do you think you'll regret not expanding, not going bigger, faster?
No. And the reason why was because I lost both my parents in my 20s, and I saw 2 hardworking people doing everything the right way. My parents worked like animals, and back a few years ago, I was like, my dad died from a heart attack in the middle of his sleep. I think it was largely due to stress. For instance, he was definitely a workaholic, and I realized, I was like, I think I'm turning into my dad. And having my first kid in 2020, amidst COVID, I was just like, you know what? I want to do projects that are fun and lucrative, and that's it. And I'd like to do them in my own backyard. And that's kind of where I'm at in my career. Yes, we do have runway for growth, but we're not going to force it.
Dude, Matt, good for you. That's really impressive, because it's hard, right? You're out there, your friends are out there. I know you see other investors scaling, and a part of you must really want that as well, but you're sticking true to what you want and what you know is going to make you happy in the long run. Good for you.
Mm-hmm.
Yeah, it's certainly compelling.
Matt, you put yourself out too on YouTube and different stuff like that. I looked into your thumbnails. They look awesome. I'm sure you get a ton on that. Talk about, since you don't really want to scale too much, can you tell us about what was your motivation? How's that going?
Yeah. So another thing that I learned from Joe Fairless is that you need a platform. So I really, really found this when I back several years ago. I'd been kind of posting on social media without really any, I guess, objective in mind, rather than just putting value out there. And I was walking on the canal, because we have the Erie Canal in Western New York, with my wife. And this guy started yelling out my name. He was like, Matt, Matt. I turned around. I didn't even recognize the guy, and I hadn't even thought of him in 10 years. And but we were connected on LinkedIn, for instance, and never liked or commented or shared anything I'd ever posted. And he was like, keep it up, man. I'm getting so much value out of it. And I truly believe that one thing also that I miss about my parents is I don't have any videos of my dad. I don't have any the last voicemail that I have from him is actually him yelling at me was back years ago. And so to be able to put valuable information out there to help people inspire, either educate them or entertain them in this wonderful opportunity we have, that I think there's no better opportunity on the entire world. We have an entire financing system and infrastructure is built out for regular everyday people to own income producing real estate. I've just been really evangelical about it, and it's also helped us raise capital and build partnerships for our deals. And also from the broker standpoint too, I meet new brokers out there. There's brokers that I meet that I haven't talked to in 6 to 12 months, for instance, and it feels like they just saw me yesterday, for instance. So that's why I've been really consistent with doing content. And I think that the more you do content and exercise that muscle, you get sort of inspired every day. I have a running list of 1,000 content ideas on my phone, for instance. And that's the reason why I'm motivated to do that. If nothing else, that if I don't get a partnership out of it or an opportunity, at least I've put some positivity out there that hopefully has been able to, even change somebody's trajectory by even a fraction of a degree.
That's inspiring.
Great, Matt. I appreciate you joining us today. I really like how you're set up. I like how you're dominating one market. I think it's really cool. And you're also killing it in office, which Osh loves to talk about that all the time because it's not multifamily. So good for you for joining us today. If anybody wants to reach out to you from Best Ever listeners, what's the best way?
Absolutely. I'm really active across all the social media platforms. If you're looking for, long form educational content, I have hundreds of hours of stuff on my YouTube channel. If you're looking to connect, I'm, active across Facebook, Instagram, LinkedIn, and happy to accept the connection request and see however I'm able to add value in you and your journey.
Awesome, Matt. Thank you so much for your time.
Yes, absolutely. Thanks for having me on.
Best Ever listeners, thanks for joining us today. If you enjoyed this episode, make sure you leave us a 5-star review and share it with somebody who could find it useful. Please follow, subscribe, and have a best ever day.